Um, Good afternoon. Today we are going to be looking at the second chapter of the textbook. And just to do a quick recap, if you still remember in the first chapter, we looked at professionalism in the investment industry, right? So we looked at professionalism in the investment industry, and we said, because now the elements of portfolio management, there's been a lot of scandal when it comes to issues where the investments were not done according to the in the best interest of the clients, and where some of the traders, they ended up even taking more risk than what was expected of them as well, whether from a client's perspective or from the company's perspective as well, or the employer's perspective. We saw that that's why you see that right now, when it comes to investment and portfolio management, there is now becoming more a bigger push towards what professionalism in the investment industry, and it's more inclined to the issues to do with what issues of ethics. So the second chapter that we're going to be looking at is another development in the investment management industry, which is to do with FinTech, right? So when you look at FinTech, the main idea behind the issues of FinTech is where we saw that we know that there is this relationship between the client, the investment advisor, and then the portfolio manager, right? Now, looking at this relationship, the FinTech is trying to make it easier during this interaction, and is also trying to make it easier when it comes to this interaction as well. Because remember now, from the portfolio manager's perspective, this is where they are now going to be making what the investment, the whole or where the money is going to be invested as well. So FinTech is trying to is basically being involved in this relationship, and also this investment relationship, where they choose now to say, where is the money going to be invested and how is the money going to be invested as well. Because remember, the portfolio manager, this is where you look at the investment of the money, which should be through for example, through a particular trader, if they're going to be investing in a trader's portfolio, or if they're going to be investing directly on their own as well, right? So which means FinTech is now trying to make these relationships a lot easier as well. So you'll see that the section that we're going to be looking at when we look at FinTech, you will see that we are now trying to find out exactly, so how do we now incorporate the progression in technology in managing components found in these relationships. So that's basically what we're going to be looking at when you look at FinTech and investment management. So we're not trying to say, how do we incorporate the use of technology in managing these relationships? So the main idea being, how do we ensure that we're able to provide efficiency in between here, and also when it comes to the product as well, and how do we ensure that we're able to improve the quality of the offering as well in between here as well. So looking at FinTech, it means on chapter 2, under introduction, they say the meeting of finance and technology, commonly known as FinTech, is changing the landscape of investment management. Advancements include the use of big data, artificial intelligence, and machine learning to evaluate investment opportunities, optimize portfolios, and mitigate risks. So these developments are affecting not only quantitative asset managers, but also fundamental asset managers who make use of these tools and technologies to engage in hybrid forms of investment decision-making. So investment advisory services are undergoing changes with the growth of automated wealth advisors or robo-advisors. And robo-advisors may assist investors without the intervention of the human advisor, or they may be used in combination with the human advisor. So the desired outcome is the ability to provide a tailored, actionable advice to investors with greater ease of access and at a lower cost. So what does that mean? We're trying to improve the quality. We're trying to improve the offering, but at the same time, we're trying to lower the costs. Remember, we say the goal of the firm is to maximize shareholders' wealth. So when you're now incorporating FinTech which is basically the interaction between finance, which is basically our major, and also technology as well, it basically means that we're trying to find out exactly how can we use technology in pursuit of maximizing shareholders' wealth. So here they say, in the area of financial record keeping, blockchain and distributed ledger technology are creating new ways to record, track, and store transactions for financial assets. So an early example of this trend is the cryptocurrency Bitcoin, but the technology is being considered in a broader set of applications. So that's basically the introduction to the chapter that we're looking at, which is what? FinTech. Now, if you check in our study guide, remember, this is coming from learning outcome 1. And here they tell us that the first 3, we have already done them in chapter 1. So now, from this chapter, these are the 3 learning outcomes we need to be able to take note from this chapter. The first one being the ability to evaluate big data, artificial intelligence, and machine learning. So you need to know exactly what they are, and you need to be able to discuss to say, so how is it now coming in and being relevant in our pursuit, in our investment offering as well. So the next one is describing FinTech applications to investment management. And the third one being the ability to discuss financial implications of distributed ledger technology. We're going to look at it as well. So on the second section, we look at what is FinTech. So for us to understand all these other learning outcomes, we need to be able to understand exactly, so what really is FinTech? So here they say, in its broadest sense, the term FinTech generally refers to technology-driven innovation occurring in the financial services industry. For the purpose of this chapter, FinTech refers to technological innovation in the design and delivery of financial services and products. Note, however, that in common usage, FinTech can also refer to companies involved in the developing the technological, the new technologies and their applications, as well as business sector that comprises such companies. So many of these innovations are challenging the traditional business models of incumbent financial service providers. So on the last statement, this is where we are basically seeing a situation where, remember, previously, where what they mean by many of these innovations are challenging the traditional business models of incumbent financial service providers. We saw traditionally that we always found the financial institution being found in the middle. So we always find financial institution being found in the middle, where the parties with excess of funds to transact through the financial institution with the parties that would demand for funds. We also saw that the party who's a seller was to transact with the financial institution so that they're able to interact with the party who's the buyer. Because instead of the buyer and the seller interacting directly, they had to go through the financial institution, because the financial institution in this case was the market maker. It was the market maker for investment. So for those who wanted to, we have excess money to invest, and for those who want what financing, they would interact through the financial institution. And the buyer and the seller, they also had to interact through the financial institution. Like, for example, when it comes to foreign currency, when you're a seller of foreign currency, you go to the bank. And when you're a buyer of a foreign currency, you go to the bank. So which means, it basically means that the financial institution was now being found in the middle of this system, because it was now being found, it's basically being found in the middle of this system, because they are the market makers. Now, what do we see? The reason why they were found in this middle of this system is mainly because you had a situation where information was not readily available, was not as readily available to either the sellers or the buyers, those who have excess funds and those who demand funds. So now, because of the readily available information through the progression of technology, through the progression of technology, and also you find that the internet is basically becoming a global community where information is becoming more readily available than it was previously. So you're now having a situation where, over time, this party and this party, they are going to find it a bit more, a lot more easier to transact directly. And this party and this party, they are going to find it a bit more easier to transact directly. You will see that later on as we cover the chapters. So which means the threat here is here, where you see that the progression in technology is now having a situation where the financial institutions had more control over the financial markets. But now these parties are becoming, because of progression in technology, they are becoming, it's becoming easier and easier for these parties to actually transact directly. And if they're able to transact directly, what advantage does it have? They're able to what? To cut the costs as well. And they're able to manage their systems better as well. So this is why they say that many of these innovations are challenging the traditional business model of incumbent financial service providers, because now they have to continue innovating on their side as well to remain relevant in this system. Are we on the same page? Any questions so far? So with that in mind, if you check under that section, there says, whereas FinTech covers a broad range of services and applications, areas of FinTech development that are more directly relevant to the investment industry include the following. The first one being analysis of large data sets, where they say, in addition to growing amounts of traditional data, such as security prices, corporate financial statements, and economic indicators, massive amounts of alternative data generated from non-traditional data sources, such as social media and sensor networks, can be integrated into portfolio managers' investment decision process and used to help generate alpha and reduce losses. When they're talking about generating alpha, this is where we say that when you're looking at generating alpha, this is where we are saying, how is the return of the portfolio compared to the required return? So it can be the required return, or it can be a benchmark return as well. So that's basically how we're talking about alpha. So when you're looking at alpha, you're basically to see exactly how is this return of this portfolio compared to the benchmark. So which means this is basically what they refer to as the alpha. Sometimes they put it as this, and also it's also referred as your what? As your excess returns. So you want to ideally want the portfolio manager to be able to generate excess returns, because it means that what they are now deeming them. So they basically means that they are the moment they outperform a particular benchmark, it means the portfolio manager is basically what deemed to be doing well. So now we're trying to find out exactly how do we now, looking at this relationship, how do we ensure that the portfolio manager is able to generate a return in excess of what the client wants, so that we know that the client is going to be happy, the company is making money, the portfolio manager, the client is also making money as well. So here they say, so where they talk about social media and sensor networks, so this is basically where they are looking at situations where they're saying, how do we use the data, the general data that you find on social media, like for example on Facebook and all those other platforms as well, to be able to now analyze the trend? Because remember, if you're able to analyze the trends, you're able to now find out exactly, so what is the likely demand and supply of a particular goods or service? And if you're able to know that, you're able to now check to see exactly, so which companies or which investments are able to actually perform well going into the future. Then you can now, as a portfolio manager, seek to what? To invest there as well. Then after this, they also look at analytical tools. And where they look at analytical tools, they say, for extremely large data sets, technologies involving artificial intelligence, computer systems capable of performing tasks that previously required human intelligence may be better suited to identify complex, nonlinear relationships than traditional quantitative methods in statistical analysis. So advances in artificial intelligence-based techniques are enabling different data analysis approaches. For example, analysts are turning to artificial intelligence to sort through the enormous amounts of data from company filings, annual reports, earning calls, to determine which data are most important and to help uncover trends and generate insights relating to human sentiment and behavior. So they're basically using data that is available, or this big data, to be able to now come up with utilize the artificial intelligence that is because of the progression in technology, for them to be able to now find out exactly what are the trends involved and how can we be able to actually better position the organization to be able to maximize shareholders' wealth as well. On the next section, they also look at automated trading. And here they say, executing investment decisions through computer algorithms or automated trading applications may provide a number of benefits to investors, including more efficient trading, lower transaction costs, anonymity, and greater access to market liquidity as well. Because remember, with automated trading, this is basically where you use the computer systems now to actually to pick trading, make trading decisions, and also be able to continuously trade on a continuous basis as well. Just as long as you put limits on which the program should be running under as well. They also say on page 17, automated advice, where they say robo-advisors or automated personal wealth management services provide investment services to a larger number of retail investors at lower cost than traditional advisor models can provide. So because these advice, the investment advice, so which means where you look at automated advice, this is basically what we're looking at. We're looking at this relationship where the client can be able to get investment advice, not necessarily by dealing with the financial advisor themselves, but they can get advice so that they're able to directly make the investment decisions on exactly where ideally where they should be able to invest the money as well. So we will see that later on in the chapter, that when it comes to robo advisors as well, they can be the robot can give you advice on its own and you make the investment decision, or you can also have a combination where there's also human interaction or the human involvement as well. And the main ultimate aim is to be able to lower the costs as much as possible, because if they're able to lower the costs, it basically means that the investor is also able to actually generate more returns as well, because the after tax or after cost returns are going to be lower. Then they also look at financial record keeping, where they say new technology such as DTL may provide secure ways to track ownership of financial assets on a peer-to-peer basis. So by using peer-to-peer interactions in which individuals or firms transact directly with each other without mediation by third party, the DTL basically reduces the need for financial intermediaries. And we're going to be looking at this later on in the chapter as well. Then from here, we look at the next section, which looks at big data. Remember, one of our learning outcomes, we were asked to look at analyze, to evaluate big data, artificial intelligence, and machine learning as well. So when you look at big data, on line number 2, they say, the term big data has been in use since the late 1990s and refers to the vast amount of data being generated by the industry, governments, individuals, or electronic devices. So big data includes data generated from traditional sources, such as stock exchange, companies, governments, as well as non-traditional data types, are also known as alternative data, arising from the use of electronic devices, social media, sensor networks, and also company exhaust. So when you talk about company exhaust, this is basically where you look at the data generated by in the normal course of doing business. Like, for example, when you look at company exhaust, this is basically where you're saying, okay, fine, over a given period of time, how many of the customers came in, how many complaints do we have? That's typical examples of what company exhaust. So it's basically data that has been generated due to the operating activities of that particular company as well. So all these now, so when you're looking at big data, you're basically looking at the traditional and also alternative data sources, so that you're able to now compile them together to come up with investment decisions that you can now be able to actually use more. So which means that with the big data, the technology now is going to allow you to now compile this information and come up with particular and be able to analyze and see particular trends, so that you're able to actually position your particular investments as well. So here they also say the term big data typically refers to data sets having the following characteristics. The first one being volume. And when you look at volume, they say the amount of data collected in files, records, and tables is very large, representing millions or even billions of data points. And when you're looking at different data points that they're talking about, these are the different data points that they're talking about, where they say when you're looking at the volume of the data can either be in megabytes, which is a megabyte is basically a million bytes, or it can be in gigabytes, which is 1 billion bytes, or it can be in terabytes, which is 1 trillion bytes, or it can be petabytes, which is basically 1 quadrillion bytes as well. So which basically means that when you're looking at big data, you're looking at data that has been compiled, that has been gathered, and it's basically coming up in coming up and taking up quite a lot of space, and needs to be to be sorted out as well. Then they also look at velocity, and here they say the speed with which the data are communicated is extremely great. So which means real-time or near real-time data have become the norm in many areas, mainly because you need real-time or near real-time data, so that you're able to actually use the computer systems now, or artificial intelligence or machine learning as well, for you to be able to now make those investment decisions as quick as possible so that you actually keep up with what the ever-changing environment in which you're operating in. But it's mainly because the reason why we're now needing machine learning and artificial intelligence is mainly because traditionally the amount of data that was needed to be able for the investment manager to be able to make the decisions there were basically very limited, because the factors that were affecting the investment decisions were very limited, mainly because there were not that many people, or there were not many factors that were affecting what different investments. But now we're living in a global community where anything happens happening in Ukraine, anything happening in Russia, anything happening in the US, anything happening in Asia, they are all going to be able to affect our performance, our investment of the investments as well. So which means that when it comes to big data, you need to be able to sort out the big data more or less in real time, so that you're able to actually make the investment decisions there also in real time, so that there's no delay in the investment decision making as well. And then you also look at variety, and here they say the data are collected from many different sources and in a variety of formats, including structured data. And structured data in this case is where you look at data that is in the form of SQL, which is basically structured query language. And here they say this is the computer language designed to elicit information from databases. Or it can be in CSV files, which is representing comma-separated values, where it is a text file that has a specific format which allows the data to be saved in a structured table as well. Like, for example, if you check under your Excel spreadsheet there, you will see that there are different formats that you are able to actually store your data. One of the formats would be CSV, which is comma delimited as well. Then the next one would be semi-structured data, like, for example, in HTML code. And the HTML code is basically hypertext markup language, where they say is the code that is used to structure a web page and its content as well. Then there's also unstructured data, which is basically the different videos that you're going to be getting or sourcing from the different sources as well, whether it's going to be social media or from the news or whatever your source you're going to be utilizing as well. So all these are characteristics of what makes up big data. And from there, you now need to be able to sort out the data so that you're able to pick up the trends and make investment decisions as well. So they give us this diagram. It's basically trying to show us the summary of what we're discussing as well, where we say, if you look at the velocity of data, there's a lot of velocity of data when it comes to real time. And if it's near real time or if it's periodic, we're dealing with in batch form. The velocity of data becomes more with how real time the data are going to be dealing with as well. So the more real time the data becomes, the higher the velocity of the data. And at the same time, when you look at the data sources as well, you will see that they can be structured, unstructured, or they can be structured or semi-structured as well, which basically means that the more you move in this particular direction, the more unstructured the data becomes as well, which basically means that you're having to sift through a lot of data for you to be able to pick up those trends as well. Are there any questions regarding exhibit 1? Is there any question regarding exhibit 1? So here under big data, they say big data may be structured, semi-structured, or unstructured. Structured data items can be organized in tables and are commonly stored in a database where each field represents the same type of information. Then unstructured data may be disparate, unorganized data that cannot be represented in tabular form. So unstructured data, such as those generated by the social media, emails, text messages, voice recordings, pictures, blogs, scanners, and sensors, often require different specialized applications and custom programs before they can be helpful to the investment professionals. So for example, in order to analyze data contained in emails or text specially developed by a customized computer code may be required to first process these files. Then semi-structured data may have attributes of both structured and unstructured data types. So are there any questions when it comes to the analysis of big data, on how you can be able to analyze and categorize big data as well? Any questions? Now, the next section that we're going to be looking at is sources of big data. And here they say, big data, therefore, encompasses data generated by the financial markets, which is data from equity trading, fixed income trading, futures, options, and other derivatives as well. Then it can also be data from different businesses as well, like, for example, corporate financial statements, commercial transactions, credit card purchases as well. Then it can also be data coming from the activities of the government through trade, economic, employment, and payroll data as well. Or it can be from data coming from individuals, which can be credit card purchases, product reviews, internet search logs, and social media posts as well. Then it can also be from sensors, which is basically the satellite imagery, shipping cargo information, and traffic pattern, and in particular. So which means when you look at sensors there, this is basically where you're now looking at data that is coming from what? From the different information that you're going to be looking at. Like, for example, shipping imagery to show you exactly, like, for example, when you look at data, satellite data that was coming from how they would analyze the blockage of the crisis that we had, the shipping crisis that we had as well, you were able to actually come up with the data to say, okay, fine, based on this information, this is how much delays we're expecting when it comes to what? The movements of our shipping, based on the information that you're going to be gathering from the different shipping lines, and also movements of the ships that you can also be able to what? To see from what? From the satellite imagery as well. So this all would be coming from what they refer to as what? Sensor data as well. Then there's also the Internet of Things, which is IoT, which is basically, for example, data generated by smart buildings, where the building is providing a steady stream of information about climate control, energy consumption, security, and other operational details. So which means that you can also give you information to say how many people went in, how many people came out, what times, what are the trends of the people coming in, roughly what time when people coming, did most people come in, and roughly what time did most people check out as well. And you can also be able to look at these trends over the different given periods of months, or even over given days in a week as well. So that's basically typical information that you can be able to find under the Internet of Things as well. So these are basically different sources that are going to be able to look into for you to be able to gather the data that you need for you to be able to to make investment decisions as well. Are there any questions when it comes to the different sources of big data? Any questions? So here they say, remember we said big data can be coming from the traditional sources, right? And the traditional sources would be, for example, when you analyze the financial statements of the company and the operational data coming from the company as well. Then you can also get big data coming from alternative data sources as well, right? So here they say there are three main sources of alternative data. It can be data generated by individuals, data generated by business processes, and data generated by by sensors. Now here they say data generated by individuals are often produced in text, video, photo, and audio formats that may also be generated through such means as website clicks or time spent on the web page. So this type of data tends to be unstructured. So the value of this type of data is growing dramatically as people participate in greater numbers and more frequently in online activities such as social media or e-commerce, including the online reviews of products, services, and entire companies, as they make personal data available through website searches, email, and other electronic trails as well. That's why you see that when you look at whenever you are going to be browsing through on the internet as well, you're always going to be having those issues of what? Of cookies, because the websites, they use that information to gather the trends of exactly what your spending habits are, so that they're able to know exactly what adverts can we give you, which are going to be popping up, for example, on your internet as well. Then another company that also look at the data generated by individuals is like typically like what you see when you look at Facebook. They check your data, you give them your data, then they analyze your scrolling habits, then they can be able to now come up with what to say, okay, fine, based on this scrolling habits, what what the customer, what the client wants as well. It basically means that they can now be able to find out exactly how do we do target marketing, and then they also use that information now for other companies to be able to actually what advertise based on your habits on Facebook as well. Then the other source of alternative data would be business process data, where they say these include information flows from operations and other public entities. So these data tend to be structured data and include direct sales information, such as credit card data, as well as corporate exhaust. So corporate exhaust includes corporate supply chain information, banking records, and retail point of sale scanner data. So business process data can be leading to real-time indicators of business performance, whereas traditional corporate metrics may be reported only on a quarterly or even yearly basis and are typically lagging indicators of what? Of performance. Mainly because when you look at the traditional sources, this is where, for example, when you look at the financial statements, you are if companies, those companies that prepare financial statements on a regular basis are those who are deemed to be what? Putting out quarterly financial statements. But in most cases, you find that what they prepare yearly financial statements as well, where now when they prepare the yearly financial statements, then you can have the annual general meeting as well, so that you are able to actually get feedback regarding the performance of the company as well. But now you're having a situation where we're living in a world that is always ever changing, where the market conditions are always going to be what? Constantly changing as well. So which means that you now need to be able to access more real-time data. So which means that you also need to now be able to utilize what? Other data sources, which is basically the alternative data sources as well, so that you're able to actually what? Make decisions now as you go, instead of just waiting for those annual financial statements, for example. Then another source of alternative data would be the sensor data. And here they say sensor data are collected from such devices as smartphones, cameras, RFID chips, and satellites that are usually connected to computers via wireless networks. So sensor data can be unstructured, and the volume of data is many orders of magnitude greater than what? That of the individual or business process what? Data streams. So this form of data is growing exponentially because microprocessors and networking technologies are increasing present in the world wide array of personal and commercial electronic devices. So the extended to the office building, homes, vehicles, and other physical forms, this cumulates in a network arrangement known as the Internet of Things that is formed by the vast array of physical devices, home appliances, smart buildings, vehicles, and other items that are embedded with electronics, sensors, software, and network connections that enable the objects of the system to interact and share information. That's why you see that, for example, soon we're going to be having a situation where even your own fridge is going to be able to now know exactly what items are missing, or what items of inventory in the fridge, your own personal fridge are missing, and so that you're able to know exactly. Sometimes you can even you are now going to be able to go to an extent where even the fridge can now be able to actually order for you those items, and then the delivery service is now going to be able to deliver that information for you. So which means that we are now, when you look at the data generated by sensors, we're basically saying that there is a wide range of different ways in which customer data can be collected as well. So there's a wide range of ways because of the progression in technology for which customer data can be collected, processed, so that they are now able to, the companies are able to actually improve their offering to their customers as well. So is there any question regarding the main sources of alternative data? Any questions? So this is summarized in Exhibit 2, which shows us the classification of alternative data sources, whether it's for individual, for business processes, and also for sensors as well. So here they say, in the search to identify new factors that may affect security prices, enhance asset selection, improve trade execution, and uncover trends, alternative data are being used to support data-driven investment models and decisions. So as interest in alternative data has risen, there has been a growth in the number of specialized firms that collect, aggregate, and sell the alternative data sources. And remember what we discussed previously, where we said a typical example that basically specializes in this is basically Meta, which is formerly known as as Facebook as well. Then they also say, while the marketplace for alternative data is expanding, investment professionals should understand the potential legal and ethical issues related to the information that is not in the public domain. So which means this is where we look at, from a South African perspective, this is where we look at the POPI Act as well, which is Protection of Personal Information Act. And that's why you see that last year there was communication either through emails or SMSs as well, where companies were confirming the consent of the use of customer data as well, to say, are you still consenting for us to be able to use that data to improve our offering as well, something along those lines. On the next section, we also looked at big data challenges. And here they say, I'll read through the whole paragraph. So here they say, big data poses several challenges when it is used in investment analysis, including the quality, volume, and appropriateness of the data. So key issues revolve around the following questions. Among others, does the data set have selection bias, missing data, or data outliers? So is the volume of collected data sufficient? So is the data set well situated or well suited for the type of analysis? And in most instances, the data must be sourced, cleansed, and organized before analysis can occur. So this process can be extremely difficult with alternative data owing to the unstructured characteristics of the data involved, which is more often qualitative than quantitative, not in nature. So this sorting out and making sense of the data, that's why you see that, for example, when it comes to many organizations as well, you will see that many organizations, they're now having the enterprise architecture departments, where with the enterprise architecture departments, they basically gather the data, then they now analyze to see exactly how do we make use of the data so that we're able to actually improve the efficiency within the particular organization as well. So there is always going to be a bigger use of the data for you to be able to improve the offering that is also offered for different departments of the organization as well. So is there any question when it comes to the concept of big data? Any questions? Now, remember we said there is a wide range of data sources that can be utilized by a company. They can get it from traditional sources, or they can get it from alternative data sources. And even if you look at alternative data sources, the data can be structured, or sometimes the data can be can be unstructured. Like, for example, the data that you get on social media. So now on the next section, we now look to say, okay, fine, the company has gathered this data. So how does what tools can the company utilize to make sense of this data? Because remember, individual or the human being might not have the capacity to actually gather that data and analyze that data and see the trends in the data as well. So this is where the issue or the concept of what artificial intelligence and machine learning comes in. So now that we have the big data, on section 4, they look at the advanced analytical tools where you look at artificial intelligence and machine learning. And here they say, artificial intelligence computer systems are capable of performing tasks that have traditionally required human intelligence. So artificial intelligence technology has enabled the development of computer systems that exhibit cognitive and decision-making ability comparable or superior to that of human beings. So when you look at machine learning, they also say on the next on paragraph number 2 on page 21, machine learning involves computer-based techniques that seek to extract knowledge from large amounts of data without making any assumptions on the data's underlying probability distribution. So the goal of machine learning algorithms is to automate decision-making process by generalizing or learning from known examples of data to determine an underlying structure of the data. So the emphasis is on the ability of the algorithm to generate structure or predictions without any help from a human. So simply put, machine learning algorithms aim to find the pattern, then apply the pattern. If you skip the next paragraph, they say, in machine learning, the computer algorithm is given inputs, which is a set of variables of data sets, and may be given outputs, which is basically the target data. So the algorithm learns from the data provided how best to model inputs to output, or how to identify or describe underlying data structures if no outputs are given. So training occurs as the algorithm identifies relationships in the data and uses the information to refine its learning process. So which means with machine learning involves splitting the data set into 3 distinct subsets: a training data set, a validation data set, and a testing data set. So the training data set allows the algorithm to identify relationships between inputs and outputs based on historical patterns in the data. Then these relationships are then validated and the model tuned using the validation data set. Then the test data set is used to test the model's ability to predict well on new data. Then once the algorithm has been trained, validated, and tested, then the machine learning model can be used to predict what outcomes based on other data sets as well. Then if you go to the next paragraph, they also say, as noted, machine learning models also require sufficiently large amounts of data and may not perform very well where there may not be enough available data to train or validate the model. So which means machine learning can only be used in an environment where there's been what? Historical data available. And the historical data has to be sufficient historical data for them to be able to actually what? Give you a reliable output as well. So here they say, analysts must also be cognizant of errors that may arise from overfitting the data, because the models that overfit the data may discover false relationships or unsubstantiated patterns that will lead to prediction errors and incorrect output focus. So overfitting occurs when the machine learning model learns the input and target data set too precisely. So in such cases, the model has been overtrained on the data and treats noise in the data as true parameters. So in machine learning model that has been overfitted to is not able to accurately predict outcomes using different data sets and may be too complex. When a model has been underfitted, The machine learning model treats true parameters as if they are noise and is not able to recognize relationships within the training data set. So in such cases, the model may be too simplistic. So underfitted model will typically fail to fully discover patterns and underlie the data as well. So please make sure that you also take notice as potential theory question to say, so when you look at machine learning, what do you mean by overfitting the data? And what do you also mean by what? Underfitting the data as well. So please take note of this as potential what? Theory questions in the exam. Any questions so far? On section 4.1 of the chapter, we look at the types of machine learning. And here they say, on line number 2, machine learning can be broadly divided into 3 distinct classes of techniques: supervised learning, unsupervised learning, and deep learning. So in supervised learning, computers learn to model relationships based on labeled training data. So in supervised learning, inputs and outputs are labeled or identified for the algorithm. So after learning how best to model relationships with the labeled data, the trained algorithm are used to model or predict outcomes for new data sets. Then in an unsupervised learning, on the next paragraph, they say, in unsupervised learning, computers are not given labeled data, but instead are given only data from which the algorithm seeks to describe the data and their structure. Then on the next paragraph, they also say, underlying artificial intelligence advances have been key developments relating to neural networks. In deep learning, which is also referred to as deep learning nets, computers use neural networks, often with many hidden layers, to perform multi-stage nonlinear data processing to identify patterns. So deep learning may use supervised or unsupervised machine learning approach. So deep learning can either use this model or it can use that model. So under this, they also say the ability to analyze big data using machine learning techniques alongside with more traditional statistical methods represents a significant development in investment research, supported by the presence of greater data availability and advances in algorithms themselves. So improvements in computing power and software processing speeds and falling storage costs have further supported this evolution. Because if you look at the improvements in processing power, you will see that previously, if you compare the laptops now and how they were compared to the laptops that you found in the 90s, the processing power is what gone up and up as well. You look at the difference processing power between the new generation and the old generation. You also look at the difference in processing power when you're now going to be comparing the i3, the i5, the i7, or if you compare that with the what is that other one, the slow one, you will see that the processing power is becoming what more and more. And even now, you will see that there are even bigger personal laptops, which are basically those ones, the gaming ones, which means that the processing power of these devices is becoming what more and more. And the bigger the processing power, the more data they're able to actually gather, and the more data they're able to actually process as well, and give what a more real-time response at the end of the day. Are there any questions so far? All right, going back to our learning outcomes, remember they say we need to be able to look at the ability to evaluate big data, artificial intelligence, and machine learning. We have done that so far. Next, we need to be able to look at the describing fintech applications to investment management. Then we also need to look at ability to discuss the financial applications of distributed ledger technology. So because of this, you will see that Section 5, I don't really see it as something relevant because they are going too much in depth when it comes to the IT concepts there and what you need to be able to take note of there as well. So you'll see that we're going to take a 10 minutes break. When we take after a 10 minutes break, from there, we're going to go on to study section 6, which looks at selected applications of FinTech to investment management as well. So can you take a 10 minutes break until 20 past 3? Then at 20 past 3, we're going to look at section 6 of the chapter. So can you take a 10 minutes break until 20 past 3? Then at 20 past 3, we're going to look at section 6 of the chapter. All right. Can we continue? So we were now looking at section 6, which looks at the selected applications of FinTech to investment management. Remember, on our learning outcomes, after we look at big data, artificial intelligence, and machine learning, we need to look at describing FinTech applications to investment management, and also the ability to discuss the financial applications of what? Distributed ledger technology as well. So looking at these, they say FinTech is being used in numerous areas of investment management. Applications of investment management include text analytics, natural language processing, robo-advisory services, risk analysis, and algorithm trading. So from here, they look at the first one, which is basically text analytics and natural language processing as well. And yet they say text analytics involves the use of computer programs to analyze and derive meaning, typically from large unstructured text or voice-based data sets, such as company filings, written reports, quarterly earnings calls, social media, email, internet posting, and surveys. So text analytics include using computer programs to perform automated information retrieval from different unrelated sources in order to aid in the decision-making process. So more analytical usage includes lexical analysis, or the analysis of the word frequency in a document, or a pattern recognition based on keywords and phrases. So text analytics can be used in predictive analysis to help identify indicators of future performance, such as consumer sentiments as well. So which means when you look at text analysis there, this is basically where you're analyzing the large amount of data from different data sources, so that you can, for example, be looking at what? Keywords, and from those keywords, you can now be able to now analyze to say, okay, fine, based on these keywords, this is basically what we are expecting to happen, or the prediction of exactly where the market would be going as well. Then there's natural language processing, where they say is a field of research at the intersection of computer science, artificial intelligence, and linguistics that focuses on developing computer programs to analyze and interpret human language. So within the larger field of text analytics, NLP, which is natural language processing, is an important application. So automated tasks using NLP include translation, speech recognition, text mining, sentiment analysis, and topic analysis as well. So this is where, for example, you look at text analysis. This is where, for example, you look at situations where, like, for example, if you're typing over time, you see that your phone is able to actually try to predict exactly what is the next word that you're trying to type as well. And then you also look at text mining, sentiment analysis, and topic analysis. Then there also may also be you look at translation, speech recognition, and text mining as well. And this is where, for example, you see that these days there are computer systems that are able to use voice recognition. You're able to use them on phones. You're even able to use them on on TVs as well, for you, where you can now press a particular button, you put in a command, and the TV basically interprets what you're saying, then types it for you, and then to confirm if it's what you're saying, then it can, if it's a program that you're searching on TV, then it searches for that particular program as well. So that's basically how you can look at natural language processing. We are now trying to synchronize the natural language that is available from human beings, so that you're now able to actually use it, where the computer is able to actually analyze the data, interpret the data, and then follow a particular command if it's going to be a command as well. So here they say NLP may also be employed in compliance functions to review employee voice and electronic communications for adherence to company or regulatory policy, inappropriate conduct, or fraud, or for ensuring private or customer information is kept confidential. So this is where, for example, you find that there are some votes where, to open that particular vote, they need to check on your voice commands. Then they also check where they can even scan your eyes and also scan your fingerprints as well. So so especially when it comes to the voice commands part, this is basically what we're talking about there, where we're saying that you can also use voice command parts to actually protect custom data as well. So if you skip the next paragraph, they say, for example, NLP may be used to monitor analyst commentary to aid investment decision making. So from an investment perspective, it can be used to analyze analyst commentary to aid in investment decision making. So here they say, financial analysts may generate earnings per share forecasts reflecting their views on a company's near-term prospects. So focusing on the forecasted earnings per share numbers could mean investors miss subtleties contained in an analyst's written research report. So since analysts tend not to change their buy, hold, or sell recommendation for a company frequently, they may instead offer nuanced commentary without making a change on their investment recommendation. So after analyzing analyst commentary, NLP can assign sentiment rating ranging from very negative to very positive for each. Then NLP can therefore be used to detect, monitor, and take shifts in sentiment, potentially ahead of the analyst's recommendation change as well. So which means machine capabilities enable this analysis to scale across thousands of companies worldwide, performing work previously done by humans as well. So is there any question regarding the section which looks at text analytics and natural language processing as well? Any questions? So the next application would be robo-advisory services. Where they say, since their emergence in 2008, a number of startup firms as well as large asset managers have introduced robo-advisory services, which provide investment solutions through online platforms, reducing the need for direct interaction with financial advisors. Then if you skip the next paragraph, they say, robo-advice tends to start with an investor questionnaire, which may include many of the categories and subcategories shown in Exhibit 4. And if you check on Exhibit 4, these are the different questionnaires that can be, that the client can be asked to fill in. So the moment the robot gathers the data, it now processes the data, then come up with with the proper advice as well. And you will see that even when you look at investment advisors as well, what they usually do is basically what can be done by the robot advisor. Although there's with the robot advisor, there's lack of of the interaction with the human being to be able to make judgments as well. Because what usually happens with the financial advisors, they ask you questions, they gather the data, they put it in the computer system. So which means that you usually have a system where the financial advisor is basically having an interaction between the robot advisor and the human input as well for you to be able to actually gather the data, then come up with a particular recommendation as well when it comes to investment advice. So here they say, Exhibit 4 is a synthesis of questionnaires created by these researchers attributed to the sources below. So once assets, liabilities, risk preferences, and target investment returns have been digitally entered by a client, the robo-advisor software produces recommendations based on algorithm rules and historical market data. They incorporate the client's certain investment parameters. Then they also say, nevertheless, current robot advisory services include automated asset allocation, trade execution, portfolio optimization, tax loss harvesting, and rebalancing for the investor portfolio as well. So those are some of the robot advisors activities that you can also be able to utilize. Then on the next paragraph, line number 3 from bottom, they say, because of their low cost structure, robo-advisors can reach underserved populations, such as the mass affluent or mass market segments, which are less able to afford a traditional financial advisor. Although please take note that if you look at the structure of the traditional financial advisor that they're talking about today, it's very different from what you find from a South African perspective as well. Because remember, from a South African perspective, you find that the financial advisor's fee is basically built into the product, where in the product, they all when like for example, if a client pays gets a life cover within the product, they charge the fee. If the client gets an investment product within the product, the financial advisor gets a fee as well. But now, what they're talking about there is structured a little bit different from the South African structure as well. Because now, when you look at the structure in developed markets, you will find that for one to be able to get assistance from a financial advisor, they literally pay a flat fee. Then they pay a flat fee. Then after they pay a flat fee, then they get the advice. Whether they decide to invest or whether they decide to get a particular product, they've already would have paid for the advice that they're getting. So please take note that there is a little bit of a difference between the structure from a South African perspective and the structure of what they're talking about, from developed economies perspective, where with the developed economic perspective, to get advice from a financial advisor, you pay a flat fee, irregardless of whether you end up taking the product or you don't end up taking the product. So because of that, you see that with the traditional financial advisors from that particular structure as well, not everyone will be able to access the services of the financial advisor. So to make it easier, that's when you now find the issue of the robo advice, where with the robo advice makes it you see that probably they make some of the services free up to a certain extent as well. Are we on the same page there? Any questions? So here they say, two types of wealth management services dominate the robo advice sector: fully automated digital wealth managers and advisor-assisted digital wealth managers. So under this, they say, with fully automated digital wealth managers, the fully automated model does not rely on assistance from a human financial advisor. So these seek to offer a low-cost solution to investing and recommend an investment portfolio which is often imposed on exchange-traded funds. So the service package may include direct deposits, periodic rebalancing, and dividend reinvestment options. Then with the advisor assisted digital wealth managers, here they say, advisor-assisted digital wealth managers provide an automated investment service along with a virtual financial advisor who is available to offer basic financial planning advice and periodic reviews by phone. So advisor-assisted digital wealth managers are capable of providing additional services that may involve a more holistic analysis of a client's assets and liabilities as well. So please take note of these two different types. So on the next page, they say, however, critics also of robo-advisors have wondered what would happen in time of crisis when people most often look to human expertise for advice. So it may not always be completely transparent why a robo-advisor chooses to make a recommendation or take a trading action that it did, unlike a human advisor who can provide his or her rationale. And finally, there may be trust issues in allowing computers to make these decisions, including worries of instances where robo-advisors might recommend inappropriate investments. So as the complexity and the size of investors' portfolio grows, robo-advisors may not be able to sufficiently address the particular preferences and needs of the investor. So that's what you need to make sure that you take note of, which may be potential shortfalls of utilizing robo-advisors as well. So please make sure that you take note of that. Now, the other application is in risk analysis. So the other application is in risk analysis, where they say, as mandated by regulators worldwide, the global investment industry has undertaken major steps to stress testing and risk assessment that involve the analysis of vast amounts of quantitative and qualitative risk data. So required data include information on the liquidity of the firm and its trading partners, balance sheet positions, credit exposures, risk-weighted assets, and risk parameters. So stress tests may also take qualitative information into consideration, such as capital planning procedures, expected business plan changes, business model sustainability, and operational risk. So which also means that if you go to the fourth paragraph under that page, which is the last paragraph, they say portfolio risk management often makes use of scenario analysis, analyzing the likely performance of the portfolio and liquidation costs under a hypothetical stress scenario or repeat of a historical stress event. For example, to understand the implications of holding a liquidating position during adverse or extreme market periods, such as financial crisis, fund managers may perform what-if scenario analysis and portfolio backtesting using point-in-time data to understand liquidation costs and portfolio consequences under different market conditions. So these backtesting simulations are often computationally intense and may be facilitated through the use of advanced artificial intelligence-based techniques as well. So this is how it can be they can be applicable when it comes to risk analysis. Is there any question regarding risk analysis? Then the other application would be algorithmic trading. And here they say algorithmic trading is the computerized buying and selling of financial instruments in accordance with pre-specified rules and guidelines. So algorithmic trading is often used to execute large institutional orders, sliding orders into smaller pieces and executing across different exchanges and trading venues. So algorithmic trading provides investors with many benefits, including speed of execution, anonymity, and low transaction costs. So over the course of a day, algorithms may continuously update and revise their execution strategy on the basis of changing prices, volume, and market volatility. So algorithms also determine the best way to price the order, whether it's going to be a limit order or a market order. So with a limit order, this is basically where you place a limit on your trading activity. Like for example, you place a limit on the maximum price that you're willing to buy, and you also place a limit on the minimum price that you're willing to buy. So you can put a limit order on whether you're buying or you're going to be selling a particular security as well. Then when it comes to market order, this basically where you give an instruction to the system or to the algorithm for it to be able to execute a particular transaction according to what the best available market prices at the moment as well. So here they say algorithms may also determine the best way to price the order and the most appropriate trading venue, like for example, an exchange or a dark pool to route what for execution. When they're talking about a dark pool, this is basically where you find that there are some, when you look at institutional investors, there are some institutional investors where if they trade a particular security, they might end up what resulting in a very big market movements if the market is not what is liquid enough, where if the market is not going to be deep when it comes to the volume, you have a situation where some institutional traders, they might end up what are influencing the movements in the market because of the way of their because of their trades as well. So what do? They go on a private they can also be allowed to go on a private platform where they're able to actually what trade these securities instead of what going on a particular exchange as well. So that's basically what they mean by dark pool. So here they say high frequency trading is a form of algorithmic trading that makes use of vast quantities of granular financial data, like for example, tick data, for example, to automatically place trades when certain conditions are met. So which means that when you look at tick data, this is basically where you look at to say on a given day, you will see that there are those candles when you're trading. So the candles will tell you exactly what has been the maximum price of the day, what has been the minimum price of the day as well. So which basically means that the tick data now shows you exactly the movement between the prices over time as well, which means that when a certain number of ticks has been achieved, that's when you can either say buy or you can either say what sell as well, depending on exactly the movement of your trade of exactly when you are going to be making a decision to buy or sell. So here they say trades are executed on ultra high speed, low latency networks in fractions of a second. So high frequency trading algorithms decide what to buy or sell and where to execute on the basis of real-time prices and market conditions, seeking to earn a profit from intraday market mispricing. So are we on the same page when it comes to algorithm trading, which is basically another use where we can utilize what artificial intelligence and machine learning as well? The last section of the chapter that we're going to be looking at is the last outcome, which is distributed ledger technology. So here they say, distributed ledger technology is technology based on distributed ledger, represents a fintech development that offers potential improvements in the area of financial record keeping. So DTL, which is distributed ledger technology, networks are being considered as an efficient means to create DTL networks are being considered as an efficient means to create, exchange, and track ownership of financial assets on a peer-to-peer basis. So potential benefits include greater accuracy, transparency, and security in securing in record keeping, faster transfer of ownership, and peer-to-peer interaction. However, the technology is not fully secure, and breaches in privacy and data protection are possible. So in addition, the processes underlying DTL generally require massive amounts of energy to verify transaction activity as well. So here they say, a distributed ledger is a type of database that may be shared among entities in a network. So in a distributed ledger, entries are recorded, stored, and distributed across a network of participants so that each participant has a matching copy of the digital database. So basic elements of DLT networks include a digital ledger, a consensus mechanism used to confirm new entries, and a participant network as well. So this is a typical example of this is where we look at the trading of cryptocurrency. We're going to look at it later on as well, where you see that this is why you see that there is now been, there's always going to be clash of interest between the traditional methods of doing business, where everything was done through the government and also through the financial institution. But now you are seeing trading that are being done through cryptocurrency, where the traditional ways of doing business are being done away with. Because what do we see? When you look at distributed ledger technology, we are basically saying that when you look at trading historically, when you look at trading historically, when you look at trading historically, we had barter trade, right? With barter trade, you will find that we have party A and party B, right? They would come in, maybe part A and part B, one of them would travel to another party, and then they will enter into a data trade where, for example, this one will say, I'll give you a cow. And then the other will say, okay, fine. In exchange, I'll give you 3 goats and maybe a bucket of what? Of millimil, right? So this is basically what we usually found when it comes to barter trade. But the financial system evolved from the barter trade system, where we saw that part A and part B wanted to trade. What was now happening? You were finding a situation where you have the financial institution coming in, right? So we now have the financial institution coming in, where party A would have a transaction with the financial system directly, and party B would also have a transaction with the financial system would also enter into a trade transaction with the financial system, right? So this is basically now what we're referring to as the traditional financial system there. So the traditional financial system of financial services there was based on this way. The financial institution came in and said, I'm going to make this trading easier. Instead of you traveling all the way looking for this one, I'm the one who's going to be the go-between, because there's not enough information for you to know whether A needs what and B needs that. So I'm coming in and making and create what B, the market maker. But now we're basically saying that the developments in technology, so which means that this is basically what we're now referring to as the traditional way of doing business. We're now having a situation where the different parties now are able to transact. The different parties they are able to transact directly. So instead of doing the transaction through the financial institution as a go-between, the different parties in a network are now coming in and doing the trading directly. So which means now you have party A coming in and you have party B coming in. I'll put it as a simple system, right? So which means part A and part B are able to trade, isn't it? Part A and part B are able to trade. But now so which means that any transaction that they do, they keep traditionally who was keeping the data? It was the financial institution. The financial institution is the one who knew exactly what transaction did you do with A and what transaction did we do with B. So they are the ones who are also able to now play around with that information so that they're able to create products so that there's continuous trading, in simple terms, between these parties with the financial system as a go-between as well. But now, when it comes to the distributed ledger network now, you're basically having a situation where A is we're now having a system where with the advancements in the systems there is a ledger that when A is part of the system, they're able to keep the ledger of the transactions of everything that has happened. And B is also able to keep the ledger of the transactions. But now, because this system is becoming more and more advanced, it basically means that it can now able to accommodate to make it a bigger system where they now have C involved. They now have what? Part D involved. And all these, they become part of a network system where they are able to interact here. Okay, they're able to interact here. They're able to, C is able to interact with B. And B is able to interact with D. And at the same time, D is able to interact with what? With A. And this one is able to interact there as well. So which means that all these parties are now going to be forming part of the system, and the information or the historical data of the transactions are being kept on the different ledger system by the different parties as well. So which means any transaction that is executed, there has to be a consensus of exactly, yes, the transaction has happened. Yes, we're in agreement that the transaction has happened within the network system as well. Historically, the financial institution was involved. That's why you see that right now, there's always going to be those discussions where the central government or the central banks are very wary when it comes to the issue of cryptocurrency, mainly because historically, the central banks and the banks are the ones where the custodians of the information are the ones where basically running running the system as well. So you're now having a situation where part A and part B, they are now able to transact on their own without the need of the financial institution. And this is where you find that there's quite a bit of friction. If you look at the statements that you hear from the central banks or even from the banks as well, it's mainly to do with the system where the different parties are able to transact. The moment you join a particular network, it basically means that you are going to be able to directly transact without having to go between the financial intermediary. So the distributed ledger network setup system is basically something like this. And a more comprehensive is basic example of that is what they're giving us on exhibit 5, which we are going to be looking at there just shortly. Are there any questions so far? So looking at the distributed ledger technology, they are basically saying features of DTL include cryptography, which is an algorithm process to encrypt data, making the data unusable if received by unauthorized parties, which enables a high level of network security and database integrity. For example, the DTL uses a cryptographic methods of proof to verify network participants' identity and for data encryption. Then the DTL has the potential to accommodate smart contracts, which are computer programs that self-execute on the basis of pre-specified terms and conditions agreed to by the parties to a contract. So examples of smart contract use are the automatic execution of contingent claims for derivatives and the instantaneous transfer of collateral in the event of default. So Exhibit 5 illustrates a distributed ledger network in which all nodes are connected to one another, each having a copy of the distributed ledger. So the term consensus is shown in the center of the network and represents the consensus mechanism in which nodes agree on the new transaction and ledger updates. So blockchain is a type of digital ledger in which information such as changes in ownership is recorded sequentially within the blocks that are then linked or chained together and secured using cryptographic methods. So if you go to the next paragraph, they say the consensus mechanism is used to verify a transaction, includes a cryptographic problem that must be solved by some computers on the network each time a transaction takes place. So the process to update the blockchain can require substantial amounts of computing power, making it very difficult and extremely expensive for an individual third party to manipulate historical data. So to manipulate historical data, an individual entity would have to control the majority of the nodes in the network. The success of the network, therefore, relies on the broad network participation. Then, after this, they give us, they say blockchain network, how the transactions get added. And they say, outlined below are the steps involved in adding a transaction to a blockchain distributed ledger. The transaction takes place between the buyer and the seller. The transaction is broadcast to the network of computers. The nodes validate the transaction details and parties to the transaction. Then once verified, the transaction is combined with other transactions to form a new block of data for the ledger. So this block of data is then added or linked to the previous block containing the data. So the transaction is considered complete and ledger is then updated as well. So under section 7.1, we now look to say, so how do we look at the permissioned or permissionless networks as well, which looks at the blockchain networks as well. So they say the DTL can take the form of permissionless or permissioned networks. So with permissionless networks are open to any user who wishes to make a transaction, and all users within the network can see all the transactions that exist in the blockchain. So in a permissionless or open DTL system, network participants can perform all network functions. So the main benefit of the permissionless network is that it does not depend on a centralized authority to confirm or deny the validity of a transaction, because this takes place through the consensus mechanism. So this means no single point of failure exists, since all transactions are recorded on a single distributed database, and every node stores a copy of the database. So once a transaction has been added to the blockchain, It cannot be changed barring manipulation. The distributed ledger becomes a permanent and immutable record of all previous transactions. So in a permissionless network, trust is not a requirement between transacting parties. So Bitcoin is a well-known use of an open permissionless network. Then on the next paragraph, they look at permissioned networks where they say, these are networks members where may be restricted from participating in certain networks activities. So controls or permissions may be used to allow varying levels of access to the ledger, from edit transaction, for example, a participant, to viewing transactions only, for example, the regulator to view certain details of the transaction, but not the full record as well. Then on section 7.2, we also look at applications of distributed ledger technology to investment management. Now, when it comes to the applications, they say potential applications of DTL to investment management include cryptocurrencies, tokenization, post-trade clearing, settlement, and compliance. Now, first looking at cryptocurrencies, they say a cryptocurrency, also known as a digital currency, operates as electronic currency and allows near real-time transactions between parties without the need of an intermediary, such as a bank. So as electronic mediums of exchange, cryptocurrencies lack physical form and are issued privately by individuals, companies, and other organizations. So most issued cryptocurrencies utilize an open DTL system in which a decentralized distributed ledger is used to record and verify all digital currency transactions. So cryptocurrencies have not traditionally been government-backed or regulated. So central banks around the world, however, are recognizing potential benefits and examining use cases for their own cryptocurrency versions. So many cryptocurrencies have a self-imposed limit on the total amount of currency they may issue. So although such limits can help maintain their store of value, it is important to note that many cryptocurrencies have experienced high levels of price volatility. So a lack of clear fundamentals underlying these currencies has contributed to their volatility. So cryptocurrencies have proven to be an attractive means for companies looking to raise capital. So an initial coin offering is an unregulated process whereby companies sell their crypto tokens to investors in exchange for fiat money or for another agreed upon cryptocurrency as well. When you look at fiat money, this is basically you look at what traditional means of money, like for example, cash or the traditional source of money that is our recognition of money as well. So here they say, an ICO is typically structured to issue digital tokens to investors that can be used to purchase future products and services being developed by the issuer. So ICOs provide an alternative to traditional regulated capital raising processes, such as initial public offerings. So compared to the regulated IPO market, ICO may have lower associated issuance costs and shorter capital raising timeframes. However, most ICOs do not typically have attached voting rights. Regulation for ICOs is under consideration in a number of jurisdictions, and there has been numerous instances of investor loss resulting from fraudulent schemes as well. So is there any question when it comes to cryptocurrency? Any question? So there's a question which says, where does DTL leave the financial institutions? Is not a threat making financial institutions obsolete as well? So that's why you see that if you look at around the world, initially there was lack of initiative for the traditional financial institution to actually accept cryptocurrency. But you see that over time, there's been growth, there's been more and more acceptance of cryptocurrencies around the world as well. That's why you see that even the bigger companies, like for example, if you look at Tesla, they have been investing quite a lot of their money in in cryptocurrency as well, mainly because over time there's been more and more acceptance of the cryptocurrency, mainly because it makes a lot of sense. Because remember, whoever came up with the system where the financial institution was traditionally the one that came in as a go-between, because of the advancements in technology and because of the more readily available information for there to be people who are able to trade directly as well. It basically means that over time, we would expect that the financial institutions, if they don't actually reinvent themselves, they might end up becoming obsolete as well. Although it's not something that is going to happen overnight. Is there any questions? Any questions? Is your question answered? All right. Let's look at tokenization. And when we look at tokenization, they say a transaction involving physical assets, such as real estate, luxury goods, and commodities, often require substantial efforts in ownership verification and examination each time a transfer in ownership takes place. So through tokenization, the process of representing ownership rights to physical assets in a blockchain or distributed ledger has the potential to streamline this process by creating a single digital record of ownership with which to verify ownership, title, and authenticity, including all historical activity. So real estate transactions that require ownership and identify verification may be one area to benefit from tokenization, because these transactions are typically labor-intensive and costly, involving decentralized paper-based records and multiple parties as well. That's why you see that you now look at the issue of what trading of NFTs as well. So something where you find that the issue of tokenization is becoming more and more acceptable these days, and you will find that when you look at although it's something that is quite new, you will see that over time you will see that the issue of utilization of what NFTs when it comes to trading of NFTs as well is going to be more acceptable, or becoming what it's going to become a lot more easier to trade in NFTs when you look at what the issue of tokenization as well. That's why you see that the advancements in technology is actually bringing in so much in the space that than the traditional what they could be offered by traditional methods as well. Like for example, if you look at it now, there's a lot of people who are actually spending a lot of money on the metaverse, where you are basically buying space on the metaverse, where companies are basically introducing the metaverse and growing the metaverse. And now you find that even other companies, they're busy spending money in purchasing space on the metaverse, where they know that over time it would be a good investment, because over time is the more people actually accept the metaverse as well, the more it's going to be actually easier for you to. It means that there's going to be more demand of the space within the metaverse, and then people would end up buying that investment as well. Which means that if you spend money now, you would expect that over time the price goes up when people are becoming more and more acceptance of the metaverse. Which means over time you are going to be able to actually buy that piece of land on the metaverse through tokenization as well. So is there any question when it comes to tokenization? Any question? Next, we look at post-trade clearing and settlement. So here they say, in the financial securities markets, post-trade processes can confirm, clear, and settle transactions are often complex.
Can I ask?
Yes, I can hear you. Lebogang, I can hear you. You can ask. Lebogang, I can hear you. You can ask your question. Lebogang?
I think she's battling with her network.
Oh, is it? Oh, okay. If you're not able to, are you able to just maybe type in the question? Are you able to type in the question if you have a question, because I can't hear you? All right, can you type in the question? In the meantime, we'll move forward. Then I'll address your question once you finish typing it in as well. On the next section, we look at post-trade clearing and settlement as well. And here they say, in the financial securities markets, post-trade processes to confirm, clear, and settle transactions are often complex and labor-intensive, requiring multiple interactions between the counterparties and financial intermediaries. So DTO has the ability to streamline existing post-trade processes by providing a near real-time trade verification, reconciliation, and settlement, thereby reducing the complexity, time, and cost associated with what processing the transaction. So a single distributed record of ownership between the network peers would eliminate the need for independent duplicative reconciliations efforts between parties and reduce the need for third-party facilitation. So a shortened settlement time frame could lessen the time exposed to counterparty risk and associated collateral requirements, while increasing the potential liquidity of assets and funds. And additionally, the use of automated contracts may also help to reduce post-trade timeframes, lowering exposure to counterparty credit risk and trade fails as well. And usually, you will find that this would come in very, very of much interest, especially when you look at the amount of time it takes when one wants to buy or sell a house. If you want to buy a house today, probably the whole transaction is going to be finished maybe after 2-3 months. So which means that, so you will see that the issue of our DOT technology would actually help lessen that time period that is also going to be involved as well. Because you see that the traditional ways of actually doing and settling the transactions would actually take long. Because even if you look at traditional record keeping as well, it was awful, where even if you say that you want to buy a particular house as well, you write a check, and when you write a check, it takes time for the check to be cleared. Then that's why you see that there was advancements in the use of EFTs as well. So there's always going to be a continuous advancement in technology, and it will be very much welcome, because you want a situation where these transactions are going to be, it's going to be easier to execute these transactions and conclude this transaction in real time, other than having to wait for a longer period of time to complete the transaction as well. On section 7.2.4, we also look at compliance, where they say regulators worldwide have imposed more stringent reporting requirements and demand greater transparency and access to data. So to meet these requirements, many firms have added staff to their post-trade and compliance groups, but these functions remain predominantly manual. So to comply with the regulations, firms need to maintain and process large amounts of data, risk-related data. So the DOT may allow regulators and firms to maintain near real-time review over transactions and other compliance-related processes. So improved post-trade reconciliations and automation through DOT can lead to more accurate record keeping and create operational efficiencies for firms' compliance and regulatory reporting processes, while providing a greater transparency and auditability of for external authorities and regulators as well. Because remember, the information in the transactions are going to be updated on a more real-time basis, and because of that, it basically means that whatever information that is going to be needed by the authorities as well is going to be more up to date, compared to where, for example, you are asked to present some information, but there are transactions which are still hanging, and they're going to be taking a lot of time. So it's going to be very difficult for the regulators now to understand exactly what is really happening in some of the transactions as well. Now, on the next table, we also look at DLT challenges. So the issues that are currently existing when it comes to the issue of the DLT as well. So here they say a number of challenges exist before a DLT may be successfully adopted by the investment industry. These include the following. There is a lack of DLT network standardization, as well as difficulty integrating with legacy systems. So you have the traditional way of doing business, and now you have so many other new DLT platforms that are where people are able to transact in as well. So you find that standardization of these platforms and also integrating them with the traditional ways of doing business is becoming more and more difficult. So which means that there's still need for them for these new innovations to actually interact with the old innovation, so that there's a better way of of moving forward when it comes to the movement from the traditional ways of doing business and the new innovative ways of doing business as well. They are not necessarily a new way, they are not necessarily a type of tokenization, but would say that, remember, tokenization is basically where we're saying that you are trying to have a situation where you have a record, an electronic record, which confirms ownership of a particular security as well. So which means tokenization would help in the trading of NFTs, mainly because there is no issues where someone can replicate. Because remember, when you look at trading of NFTs, you can be able to trade anything. You can be able to trade a picture. You can be able to trade so many other things as well. So when it comes to the record keeping of the transactions that are done on NFTs as well, this is basically where tokenization would actually come in being very handy as well. Because remember, with tokenization, it basically means that the digital document which confirms ownership of a particular item as well is basically going to be is going to be there, and it's going to be having a unique identity as well. So it's not necessarily in tokenization, it's not a type of NFT. It's basically one of the ways that you can actually be able to verify the transactions that are done when it comes to NFTs as well, because you're going to be having a digital blueprint of the unique copy of a particular transaction that is going to be traded on the NFT platform. Are we on the same page there? Are we together? All right. So on the second challenge, they say DLT processing capabilities may not be financially competitive with existing solutions as well. Because remember, we saw that there's quite a lot of energy intensive activity that needs to be happening as well, which basically means that when it comes to the small transactions, they might not be as financially making sense when it comes to small transactions, because they might only be making sense when it comes to big transactions that are not small transactions that needs to be involved as well. Then the third one is increasing the scale of DLT systems requires substantial resources. Because remember, with DLT systems, we're basically looking at where you're going to be having a lot of data that you're going to be gathering, and that data needs to be stored as well. So you find that's why you see that some company now, although there's been progress when it comes to our storage systems, because if you look at the progression into our storage systems, there you had a situation where historically we had big computers that would cover a whole house, and the capacity of their storage is basically less than what a flash drive can also be able to hold as well. But over time, you see that there's been improvements when it comes to storage capacity. So which means that the more improvements we have in storage capacity, the more we're able to actually utilize these DLT systems as well. Then the next one is immutability of transactions, means accidental or cancelled trades can be undone only by submitting an equal or offsetting trade, because whatever trade is done, and everyone is having a concern that the trade has been done as well. If it eventually gets cancelled or is an accidental trade as well, it basically means that it's going to be very difficult to actually wipe it out and say as an error and wipe it out completely and put another transaction. It basically means that there has to be an equal offsetting trade that is going to what? Remove that as well. Because remember, all the nodes, they have to be in agreement on a particular trade. So if there's going to be any mistake, it basically means that the only other way of actually correcting it is by what? Creating an offsetting transaction as well. Then they also say the DLT requires huge amounts of computer power, normally associated with what? High electricity usage. That's why you look at, for example, you talk about cryptocurrency, Bitcoin mining as well. They're basically saying that there's going to be what? There's usually high electricity usage. And even when it comes to the data storage as well, there's going to be high computer usage, mainly because the electricity usage, because what? There's going to be need for a lot of hardware that needs to be what? Maintained with the electricity system as well. Then regulated approaches may differ by jurisdiction. So because you see that the governments, they take time to actually regulate these new innovations as well. That's why you see that, for example, if you look at it from what is currently happening now, the government has actually been taking long to actually come to a conclusion to say, so how are we going to be able to regulate these new innovations, like, for example, the Uber and the Bolt? So you have a situation where the Uber and the Bolt drivers are striking, and then there's going to be issues with Uber, and there's no clear way forward on exactly how these new innovations can be regulated as well. And in most cases, it takes a lot of time for the regulation to be put in place. And by then, there can even be another new innovation that comes in as well. So you have a situation where regulatory issues, the regulation basically takes time to be implemented. And even if it's implemented as well, there's situations where country laws are going to be different, and in laws or regulations in different places are also going to be differing as well. So which means that standardization of all this is going to be very difficult when it comes to the DLT databases as well. So these are the current challenges that are being experienced when it comes to the DL technology. Are there any questions? Are there any questions when it comes to FinTech in investment management? Any questions?
Nothing from my side. Thank you, Linus.
All right. So you will see that the first two chapters, it was quite a lot of theory that we needed to go through, and it's new things, and it's more up to date, I would say, compared to what we've been doing previously when it comes to investment management. Because remember, now you will see that there is now more acceptance of new innovations that we're actually incorporating into our curriculum than historically or previously. So which means that it's a good thing, because we're becoming more and more updated when it comes to the knowledge that we need to be able to know exactly. Because there's no point of you knowing the traditional ways of doing things when there are no new innovative ways of working, especially in the investment management space as well. So it's a welcome change. It's a good change, and it gives you more updated skill sets when it comes to investment management as well. So the first two chapters, it was a lot of theory that needs to be consumed. So you see that after this, in this next learning unit, we're going to be looking at capital market expectations, and it's going to be covering chapter 3 and chapter 4. And this is where we're now going to be looking more and more on the space where we're going to be doing a lot of calculations, and also learning quite a lot of models that you need to be able to know exactly and know how to implement them as well. So you see that from now onwards, instead of dealing more with theory, we are now becoming entering into a space where it's becoming more calculation-based type of analysis as well, which is a bit more interesting, because theory all the time for 3 hours, it's quite a bit of quite a bit of a knock to be just discussing without doing a bit of calculations as well. So in the next class, we're going to be looking at chapter 3, which looks at capital market expectations. Then after that, we'll also look at chapter 4, which is the second part of capital market expectations as well. So it's going to be a bit more practical. So I would find it a bit more interesting on my side. So please make sure that you review chapters 1 and chapter 2, because in the exam, this is where you can potentially find theory questions. And you will see that chapter 1, which looks at professionalism as well, the issue of ethics, the questions on ethics, they are very tricky because if they ask you as a multiple choice type of question, if it comes in a format where it's a multiple choice type of question, all the answers might end up looking the same. It's possible because if you look at the way they set the CFA exams as well, when it comes to theory on ethics, you will see that the answers look the same. It's just one word or one letter that makes what the whole sentence different as well. So please make sure that you review what we've done in chapter 1 and in chapter 2, because in the exam, expect a bit of theory questions to be coming in the exam. And if they come, chapter 1 and chapter 2, they should be having a couple of theory questions that you should expect in the exam as well. But as a guideline, always refer to what the lecturer is saying that is the learning outcome from each chapter, so that we know exactly, we don't steer away from what we should be doing as well. Are there any questions? Any questions?
Yeah, I have a question. So this is my first time joining this call. I just want to ask firstly, is this the second session or has there been like other sessions, many other sessions before this one?
Is the second session. The first class that we did, we were looking at chapter 1, which is professionalism in the investment industry. Did you manage to get a link to the video that we did? Because for the first 2 classes where we covered in chapters 1 and 2, we are going to make the videos publicly available to everyone. So if you don't have it, just check on your group admin on WhatsApp. You'll be able to get the link to the video of the class that we did, the first class.
Okay, fine. Thank you. I'll do that. The second question is, is this sort of the approach that we're going to be following moving forward, in terms of you like reading through the textbook and, you know, talking through that, or you're going to be preparing some material for us above and beyond the textbook, considering that we're going to be moving from theory now to more practical work?
So what we're going to do is, if you look at the approach on the curriculum, it's always very tricky to, when you're teaching a new stream of students, when you're teaching students on a new type of textbook, because remember, this is the first time this textbook has been used. So you don't know how the lecturer is going to be structuring the textbook. I mean, how the lecturer is going to be structuring the questions in the exam as well. Because historically, in the previous textbook, we already knew exactly what sections the lecturer emphasized on and what sections the lecturer didn't really emphasize much on as well. So we need to try as much as possible to look in depth when it comes to the questions. But what we'll do is, going on to chapter 3, chapter 4, up to a certain chapter, we're going to cover those sections, go through the examples, prepare homework questions, give you the homework questions, then you go through and do the homework questions, then we do the homework questions in class as well. So that's basically more or less of what we're going to do. So after a couple of chapters, I'm going to give you homework questions. You look at the homework questions, and then we review the homework questions together in class. Then we go on for another chapters. And also, as we are going through the chapters as well, you will see that there is now going to be those type of example type of questions where they give you a particular question or a calculation there. Then we need to be able to know exactly how to utilize a particular model or a particular question, or how to answer a particular question as well. So we're going to be having a hybrid between going to the textbook, reviewing the examples in the textbook, and also preparing homework questions as well. So that because we will see that even when you eventually go through the revision program, because between now until you finish end of October, that's when we should be going through the different learning units and finishing them. So anything in the textbook, based on what is expected to be known on the learning units, that's what we're going to be doing. Then for November, December, January, until you write in February, what we're going to be doing is that we're now going to go back and say, okay, fine, since you are this first group, it basically means that we're going to be picking questions as well from the different, from the workbook and all those other sources as well, and compiling questions for you to be able to use. And you will see that some of the questions from last year or from the previous years, they're still relevant. But we have to be very careful on what material we're going to be giving you, because we need to make sure that we don't waste time by giving you information that is no longer relevant as well. So I would say be very wary when you go through, if you're going to be going through the past papers, because some of the information is no longer relevant, and some of the information is still relevant, although they've changed it here and there as well. Are we on the same page?
Yeah, no, thanks. The
All right,
last
okay.
question is around assessments, right?
Mhm.
Are we going to be working towards preparing for those? What sort of the
All right. So what we're going to do is, when it comes to the assignments, a couple of weeks before the assignment due date, we go through them together in class. But I always avoid going to the assignments before we've gone or been introduced to a particular section that is asked in the assignment as well, because it needs to be making a bit of sense to you for you to understand exactly what is being asked in the assignments and what we've gone through. So we need to try to cover as much ground as possible, so that even though we go through the assignments, when you haven't covered 100% of the material, at least you'll be having an idea of exactly what is expected of you as well. But the assignments, we will go through them together in class.
All right, thank you.
All right. Are there any other questions? Any other questions?
Hi, sir. I hope you
Mhm.
can hear me now.
Yes, I can hear you.
Yes, I just wanted to make sure, because the e-tutor on my UNISA spoke about a workbook. So I want to ask, is the workbook the textbook, or what's going on?
Okay. Remember, okay, let me quickly open the workbook so that I can demonstrate what I'm trying to. So if you look at the workbook, let me just quickly highlight, open the workbook now.
So
Like, for
while
example, when it comes to chapter 1, which looks at professionalism, you see that the workbook just basically have a summary of what is covered in chapter 1. Then it looks at practice problem. Chapter 2 as well, it gives you a summary and it gives you practice problem. So the workbook is not something that I'll say we need to go through. It's basically a source of information that you need. Remember, we said that we're going to be preparing those homework questions. After we've covered a couple of chapters, we'll look at homework questions as well. So, and also, since the new curriculum, during the revision period, we're going to be looking at picking questions that are going to be used to prepare for the exam as well. So this is basically where the workbook is going to be coming in. It's not a sign that I would say, just look at the workbook, then after looking at the workbook, look at the questions. No, you need to go through the textbook, because from the textbook, this is where you get an in-depth analysis of the concept. Then when it comes to the question that you can use to practice, that's when you cannot refer to the workbook now to say, based on this particular chapter, these are the questions that I can look at and use them to practice as well in preparation for the exam.
Okay, and then the last question I have, I want to ask if it's advisable to just go through the outlined sort of what we're supposed to know. So I don't know what you call them, but it's there in the textbook as well as the notes that are given to us. Do we just go through that? Is that advisable, or should we go through the entire chapter, like for each and every single chapter?
My advice would be, if you check what the lecturer gives you there, use this as a guideline. You see, like, for example, assessment criteria says the understanding of professionalism and that management will be demonstrated by. So these are the things that you expect you to know from that particular chapter. So which means if you're going to be asked questions in the exam, this is where the lecturer is now going to say, okay, fine. I said that the assessment criteria is this one, which basically means that if this is the assessment criteria, it basically means that if I'm going to be asking questions in the exam, I'm going to be basing them on the assessment criteria, because the assessment criteria guides you on exactly what to expect in the exam and what needs to be covered in the textbook as well. So my advice would be check that's why you see that when we go on to the next chapter, where the next chapter is going to be asking us to look at evaluating the capital market expectations and asset allocation as well. We're going to check to see what is the assessment criteria. And based on that, we now check to see exactly how is it addressed in the textbook as well.
Okay, thank you.
All right. Are there any other questions? All right, if there are no other questions, enjoy the rest of your week. Please try as much as possible to read through in advance, because the new curriculum, because the new textbook, we are not going to be able to give you, we are very wary of giving you material from last year, because we don't want to end up giving you information that is what? Irrelevant as well. So try as much as possible to just peruse through the textbook, highlight things that you don't understand, so that when you come to class, you're able to ask questions on what you are able, where you struggled as well. In that way, you're able to actually consume the information better as well. All right, enjoy the rest of the weekends.